Welcome to the deep dive. Today, we're peeling back the layers on something really fundamental, but maybe a bit invisible in global business, our mission. To really get our heads around the structure, the whole conceptual philosophy, and the regulatory rules that tells companies how to report their finances globally, specifically using the IFRS system.
Yeah, in this framework, you can think of it almost like a GPS for global finance. It's meant to be a shortcut, really. Instead of wading through just endless specific rules, it gives you these core principles. And the point is to make sure that the financial statements you see from any company, anywhere, are, relevant and reliable enough for you, the investor, the lender, whoever, to make smart decisions about where resources go.
Okay, so we're going to unpack this whole system. We'll go from the big global bodies setting the standards right down to the sort of philosophical ideas that make a number actually trustworthy. Right, let's start with the basic structure there. This system for global reporting, it works with what people call a dual architecture. So two main pillars, right? The regulatory framework and the conceptual framework.
Exactly. The regulatory part, that's like the legal scaffolding. Think national company laws, rules from stock exchanges, maybe directives from places like the EU. Its job is basically setting a minimum standard. It's the legally enforceable bit that ensures users get at least a certain amount of relevant information. IFRS standards themselves, they need this context to have, well, real legal teeth. They don't operate in a vacuum.
Okay, so the regulatory framework is the legal floor, the minimum requirement. And if those are the guardrails, then the conceptual framework, sometimes just called the framework, that's more the philosophy behind it all, the why.
That's a great way to put it. It's the foundation, is where the standard setter, the ISB, gets its guidance. And what's really key here is that the framework tackles the big questions. What are we even trying to achieve with financial reports? What actually makes information useful? And linking this back, this conceptual framework is vital because it helps avoid what's sometimes called firefighting.
Firefighting. That sounds pretty reactive. What's that mean practically?
Well, it means developing standards just in response to the latest crisis or scandal, sort of patching holes as they appear. And if you do that, you end up with rules that are fragmented, inconsistent, maybe even contradictory over time. By having this core conceptual framework, the IASB tries to ensure every new standard fits into a consistent, principled system that supports generally accepted accounting practice globally.
That idea of global consistency leads us nicely to the organizations involved. So zooming out, we've got the IFRS Foundation, which is the overall supervisor, but the body actually writing the rules, the one solely responsible for issuing the IFRS standards. That's the International Accounting Standards Board, the IASB.
And the ISB's big goal is harmonization, developing these high-quality, understandable, enforceable global standards. And the push for that has huge advantages in today's world, obviously.
Oh, absolutely. Think about the big multinational companies, right? If reporting is harmonized, getting international finance is easier because investors everywhere understand their numbers. And it makes their own internal operations much simpler. Consolidating results from subsidiaries in different countries becomes way easier.
And for you, the user, the investor, it means you can actually compare, say, a company in Germany with one in Brazil more reliably.
Yeah.
You're speaking the same accounting language, essentially. Makes your decisions better informed.
Okay, harmonization sounds great in theory, but getting there?
Yeah.
That can't be easy. There must be pushback or disadvantages.
Oh, definitely. It runs into friction. Trying to impose one single standard across countries with wildly different legal systems, political priorities, even social norms, that's tough. Sometimes the fundamental purpose of reporting clashes. Like in some countries, the main goal is calculating tax. That's priority one. Whereas IFRS is really geared towards giving investors useful information. Getting everyone to agree on the primary goal can be, well, a real challenge. Plus, sometimes countries just don't want to adopt another country's way of doing things.
And this is where things get really interesting lately, showing how the framework adapts. Because in 2021, the IFRS Foundation saw this huge growing need around climate and social issues. So what did they do? They set up a whole new board, the International Sustainability Standards Board, or ISSB.
Right. The ISSB's mission is basically to create a global baseline for reporting on sustainability. And their first standard, IFRS S1, it builds directly on that existing conceptual framework we talked about. It tries to tie sustainability risks and opportunities back to concrete financial reality.
That's the crucial bit for users, I think. IFRS S1 says companies need to disclose sustainability risks and opportunities that could reasonably be expected to affect their cash flows, their access to finance, or their cost of capital. So it forces sustainability talk to pass that relevance test. And it asks for info across 4 areas: governance, strategy, risk management, and metrics and targets.
Okay, so shifting from the global bodies back to the philosophy, there's this ongoing debate, isn't there, about different approaches to standard setting,
Mhm.
principles versus rules.
Yeah, that's a core distinction. The IASB with IFRS generally takes a principles-based approach. It relies on the conceptual framework to guide professional judgment. The focus is on the economic substance of what happened, not just ticking boxes.
Whereas the rules-based approach, often linked with the U.S. system, U.S. GAAP, is sometimes called the cookbook approach. Loads of very detailed, specific rules for almost every situation. Exactly. And look, both have pros and cons, right? The rules-based system, because it's so prescriptive, can lead to higher comparability, maybe more verifiability, less room for managers to, shall we say, creatively interpret things.
But the downside.
Well, you can lose sight of the big picture. You might follow the rule perfectly, but miss the underlying economic reality. The principles-based approach, while needing more judgment, aims for deeper consistency with the core concepts. Substance over form, really.
So let's connect all this back to the actual numbers you read in a financial report. The ultimate aim of this whole structure, this framework, is to give useful information to investors, lenders, creditors, anyone making resource decisions. And the conceptual framework spells out what makes information useful. It starts with two fundamental characteristics. These are the must-haves.
Absolutely non-negotiable. If the info doesn't have these two qualities, it's basically useless for decision-making.
Okay, first one, relevance. Seems obvious, but what does it really mean here?
Information is relevant if it's capable of making a difference in your decisions. And relevance itself has two parts. Think of it as looking forward and looking back. The forward-looking part is predictive value. Does it help you forecast the future, like estimating next year's profits? The backward-looking part is confirmatory value. Does it help you confirm or correct your past expectations? Did that investment actually pay off like you thought it would?
But hang on, couldn't almost anything be argued as relevant somehow? How do you stop reports becoming massively bloated?
Good question. That's where materiality comes in. Materiality is like the gatekeeper for relevance. Information is considered material if leaving it out or misstating it could reasonably be expected to influence the decisions users make. If it wouldn't change anyone's decision, well, then it's not material, and therefore it fails the relevance test. It doesn't need to be separately disclosed.
And materiality isn't just a simple number, is it? Like anything over X dollars. It requires judgment.
Totally. It's very context-specific. $10,000 might be nothing to a giant corporation, but it could be make or break for small business. And because it needs judgment, it links right back to that principles versus rules thing. The principles approach expects management to judge what's truly material to users like you.
Okay, that's relevance and its gatekeeper, materiality. What's the second fundamental characteristic?
The second one is faithful representation. This is really core to the principles-based idea. It means the information has to represent the underlying economics, the substance of the transaction or event, not just its legal form.
Substance over form again. And how do you ensure that?
Well, faithful representation itself needs three things. First, completeness. You need all the necessary descriptions and explanations, nothing important left out. Second, neutrality. The information has to be free from bias. Management shouldn't be slanting the numbers to make things look better or worse than they are.
And the third?
Free from error. Now, this needs a bit of care. It doesn't mean perfect accuracy down to the last cent. Lots of accounting involves estimates, and that's okay. What it means is that there are no errors in describing the facts, and the process used to produce the reported information, like making an estimate, has been applied correctly without errors.
Okay, so those are the fundamentals. Relevance and faithful representation. Must-haves. Then there are the enhancing characteristics, the nice-to-haves.
Exactly. These make good information even better, more useful. First is comparability. This lets you spot trends. It means you should be able to compare a company's results over time, that's consistency, and also compare that company against others in the same industry. That requires good disclosure policies.
Makes sense. What else?
Then there's verifiability. This means different knowledgeable observers could reach a consensus, though not necessarily a complete agreement, that a particular depiction is a faithful representation. You might verify something directly, like counting cash, or indirectly, like checking the inputs to a model and recalculating the output.
Okay, comparability, verifiability.
Next up is timeliness. Pretty straightforward. The information needs to be available to decision makers before it loses its ability to influence their decisions.
No.
Older information is generally less useful.
Right, last week's report is better than last year's. And the final enhancing characteristic.
Understandability. This means classifying, characterizing, and presenting information clearly and concisely. but it's a two-way street. Understandability also assumes that you, the user, have a reasonable knowledge of business and economic activities, and that you'll review and analyze the information diligently. It doesn't mean simplifying things down to the point where they lose relevance.
Got it. So reasonable effort expected from both sides. Okay, before we wrap this up, the framework needs a clear language, right? Specific definitions for the basic building blocks of financial statements.
Absolutely crucial. The conceptual framework gives precise definitions for the five core elements. Let's run through them quickly. An asset is a present economic resource controlled by the entity because of past events, and that resource has to have the potential to produce economic benefits.
Okay, present resource, past event, future benefit potential, and a liability.
It's a present obligation of the entity to transfer an economic resource, again, as a result of past events. Notice how past events anchors both definitions.
Right, and if you take assets and subtract liabilities.
You get equity. It's the residual interest in the assets after deducting all the liabilities,
Yeah.
what's left over for the owners.
And the performance elements, income and expenses.
Income covers increases in assets or decreases in liabilities that result in an increase in equity. But importantly, not including contributions from the equity holders themselves, like selling new shares. And expenses are the opposite. Decreases in assets or increases in liabilities that decrease equity, other than distributions back to equity holders, like dividends. Having these tight, consistent definitions is what makes the whole system hang together. Everything is measured against the same basic concepts.
Okay, wow. We've covered a lot of ground there, the whole architecture. We've seen the regulatory guardrails and the conceptual GPS guiding global finance, and we now understand what really makes financial information useful. Those core ideas of relevance and faithful representation.
Yeah, and it's worth remembering, as a final point on the mechanics, the conceptual framework provides the foundation, the philosophy, but it isn't an IFRS standard itself. If, in a very rare case, there's a conflict between the framework's principles and a specific rule in an IFRS standard, well, the standard wins. The specific rule takes precedence.
That's a key practical point. And it raises a really interesting question to leave you with thinking about the future. We talked about the new ISSB and its sustainability standards dealing with long-term issues like climate change. So think about this. How will concepts like materiality and timeliness, which were really developed for, faster-paced annual financial cycles, how will they be tested, maybe even redefined when we apply them to environmental and social risks that might play out over decades? That's definitely something to mull over.